The S&P 500 is down 20%. Your 401k balance, the number you check every morning like it's your blood pressure, has lost roughly 1/5 of its numerical value. CNBC has deployed its full red banner emergency graphics package. 3 analysts in identical blazers are taking turns yelling at each other about the Federal Reserve, systemic risk, and something called contagion. The chyron at the bottom of the screen is scrolling faster than your net worth is falling, and somehow that makes it worse. You feel it in your chest, that specific biological panic, the kind that evolved over 40,000 years to get your ancestors away from large predators. Your cortisol is spiking. Your palms are producing moisture. Your brain is generating exactly one thought, on repeat, at maximum volume. Do something. Do something now. Stop the bleeding. A recession is not an emergency. It is an audit. Let me be precise about what that means. An audit is a systematic examination of a system's performance against its expected parameters. It does not destroy the system. It reveals it. It shows you exactly which components are load-bearing and which are decorative. It shows you which decisions were architecture and which were ego. A recession is the market system running its scheduled diagnostic protocol on every human operating within it. And what it is looking for, what it always finds, is emotional entropy. Emotional entropy. That is the core variable we are solving for today. Entropy, in engineering terms, is the tendency of any closed system to move from order toward disorder without the input of energy. In financial terms, emotional entropy is what happens when a human investor substitutes biological fear responses for logical capital allocation decisions. It introduces chaos into a perfectly architected system. It converts variance, which is temporary, mathematical, and already priced into the long-term return model, into permanent, structural loss. And it happens, statistically, to the majority of American middle-class investors every single time the market executes a correction. The market is not breaking. The S&P 500 is not malfunctioning. 500 of the largest American companies are still open. They are still processing transactions, still shipping product, still collecting receivables, still paying employees. The system is operating within its documented parameters. The only component in this architecture that is actually failing is you. So let's run the diagnostic.
I want to walk you through the exact failure sequence of what I call the standard American investor during a market downturn. This is not a hypothetical. This is a documented behavioral pattern, repeatable and predictable across every major correction since the data has existed to measure it. 2008, 2020, 2022. The script is identical. Day 1 of the correction. The investor notices their brokerage app is showing red. Not dramatically red, just red. They refresh. Still red. They open CNBC. The red banners appear. An analyst uses the word unprecedented. The investor's threat detection system, which cannot distinguish between a bear and a bear market, registers a level 2 alert. Day 3. The losses have compounded. The investor is now checking their balance 14 times a day. Each check produces a new cortisol spike. Each cortisol spike degrades the prefrontal cortex's ability to perform rational analysis. This is not metaphor. This is documented neurochemistry. The part of your brain responsible for long-term planning is being chemically suppressed by the part of your brain that is trying to run from a lion that does not exist. Day 7. The investor sells. And here is where we must talk about the mathematics, because the mathematics are brutal and they do not care about your feelings. There are 2 types of loss events in a portfolio. The first is an unrealized paper drop, an NAV fluctuation. Your brokerage account shows a lower number. That number reflects the current market price of your shares, but you still own the same number of shares. The underlying companies have not changed their fundamental revenue architecture. Nothing has been destroyed. The price tag changed. The asset did not. The second type of loss is a realized loss. That is when you sell. The moment you execute that sell order, you have converted a temporary price fluctuation into a permanent capital destruction event. You have taken a number that was going to recover, because it has always recovered in every documented case in the entire history of the U.S. equity market, and you have locked it in as a loss. You have closed the position. The machine cannot recover what you have already removed from the system. Let me give you an analogy that even a human nervous system can process. Imagine you own a house. You paid $300,000 for it. The Zillow algorithm, which is not a human and does not have opinions, updates its estimate and says your house is now worth $210,000. A 30% paper drop. Do you call a realtor at 6 in the morning and list it for $150,000? Do you accept a panic bid from a cash buyer who is specifically exploiting your fear? Do you take the permanent realized loss to escape the temporary paper fluctuation? No, of course you don't, because your house is a physical object and you can see that it still has walls and a roof. You can see that the neighborhood is still there. You know intuitively that Zillow's number is not reality. It is an estimate of liquidity value in a specific moment. You would wait. You would hold. You know the number will recover. Your index fund shares have walls and a roof. They have revenue and earnings and dividends and employees and infrastructure. The only difference is that you cannot see them, and CNBC is not doing a segment on your house. The panic sell is not a strategy. It is a biological malfunction with a quantifiable dollar cost, and we're going to calculate exactly what that cost is in the next section.
Now we arrive at what I consider the most expensive lie in retail investing. It is a sentence you have either thought or said out loud during a market downturn, possibly in the last 12 months. The sentence is this: I'm just going to move to cash to wait out the storm, and I'll buy back in when things feel safer. I want to dissect every component of that sentence because every component is wrong.
First, wait out the storm. This phrase implies that the storm has a defined endpoint that you will be able to identify in real time. You will not. Nobody can. If professional fund managers with Bloomberg terminals, quantitative analysts, and decades of institutional experience cannot consistently time market re-entry, you are not going to do it from your couch watching CNBC. The research on this is not ambiguous. Dalbar's annual quantitative analysis of investor behavior study has documented for over 30 consecutive years that the average retail investor consistently underperforms the index they are invested in, not because the index is bad, but because they keep leaving and re-entering at the wrong moments. Second, and this is the part that should concern you most, the best days in the market and the worst days in the market are not separated by months. They are separated by days, sometimes hours. The research from JP Morgan shows that if you were invested in the S&P 500 for the 20 years between 2003 and 2023, a 2-decade window, and you missed just the 10 best single days in that entire period, your total return dropped from approximately 9.8% annualized to 5.6%. Missing 10 days out of approximately 5,000 trading days cut your return nearly in half. If you missed the 20 best days, you went from 9.8% to 2.9%. You would have nearly matched inflation and called it investing. And when do those best days occur? Immediately after the worst days, during the exact period when you are sitting in cash, waiting for things to feel safe, congratulating yourself on your caution. The recovery happens without you. The compounding happens without you. The machine processes its scheduled inputs and outputs, and you are not in the loop. Third, when things feel safer. I need you to hear this clearly. Things will not feel safer until the market has already recovered. That is the nature of narrative lag. The news cycle does not report safety, it reports drama. By the time CNBC is running segments on market resilience and record highs, The re-entry point you were waiting for is already 6 months and 15% in your rearview mirror. You will buy back in at the top because that is when the emotional signal finally says it is acceptable. Now let us address the specific failure of cash as an asset class. In 2024, U.S. inflation was still operating above the Federal Reserve's 2% target. The long-term structural average of inflation in the United States is approximately 3 to 3.5% annually. Your cash in a savings account, even in a high-yield environment, is fighting a losing battle against a guaranteed, government-documented headwind. Cash is not a safe harbor. Cash is a depreciating asset with a known decay rate. Going to cash is not pausing the game. It is choosing guaranteed, slow, structural bleeding over temporary, documented, historically reversible volatility. Those are not equivalent options. One of them has always recovered. The other one never stops losing.
Let me now give you the reframe, because if you have been listening with any degree of rational processing, you should be arriving at a question. If crashes are temporary, if cash is structurally inferior, if panic sells are permanent capital destruction, then what is a crash, actually? What is the correct mental model? A crash is a sale. More specifically, it is a sale on future cash flow.
Here is the architecture. When you buy a share of a broad index fund, let's use a total market or S&P 500 index as the reference system, you are purchasing a fractional ownership stake in approximately 500 of the most durable revenue-generating machines in the American economy. These companies are selling goods and services, they are collecting revenue, they are, in many cases, paying dividends directly into your account on a quarterly schedule. The underlying operational reality of those companies does not change because the stock price changes. Think of it in API terms. You have a data endpoint, let's call it the S&P 500 API. This endpoint, over its documented history, has returned an average annualized yield of approximately 9 to 10%. That is the expected API response. Now, there is a period where the API's listed price drops 20%. The API is still running. It is still returning data. The underlying servers, 500 American companies, are still operational. The response quality has not degraded. The endpoint has not been deprecated. The only thing that changed is the cost of access. So here is the question I need you to answer with your prefrontal cortex and not your amygdala.
If your cloud infrastructure provider sent you an email tomorrow morning saying all compute resources are 20% cheaper effective immediately, would you cancel your subscription? Would you migrate your workloads to a more expensive provider? Or would you deploy more capital into the system while the inputs are discounted? This is not a complicated question. The hardware is on sale. The API is still returning data. Future cash flows are available at a 20% discount to what they were trading at last month. From a pure capital allocation standpoint, setting aside every biological impulse your nervous system is generating, a crash is not a crisis. It is an opportunity window with a historically documented close date. The only investors who benefit from that window are the ones who stay in the system when their biology is screaming at them to leave.
And this is where we arrive at the actual solution, because everything I have told you so far is theoretically useful and practically insufficient. Knowing that panic selling is irrational does not stop the cortisol spike. Knowing that cash depreciates does not eliminate the comfort of seeing a stable number on a screen. Understanding the engineering logic of a sale does not override 40,000 years of loss aversion wiring. You cannot think your way out of a biological response in real time. The latency is too high. The solution is to remove yourself from the execution loop entirely. Your brain evolved to operate in an environment where threats were immediate, physical, and required instant action. A predator does not give you time to calculate expected return on investment. A market correction does, but your nervous system is not calibrated to recognize that distinction. It processes portfolio down 20% and large animal approaching through overlapping threat detection architecture, and it produces the same output. Act now, stop the loss. The automation protocol is the engineering solution to a biological problem. Here is the implementation. You define, in advance, during a period of emotional neutrality, not during a correction, your monthly capital deployment rate. This is the fixed dollar amount you will deploy into your target index positions every single month, regardless of market conditions. You set this up as an automatic recurring investment through your brokerage. Fidelity allows it. Vanguard allows it. Schwab allows it. You set the amount, you set the date, you authorize the recurring transaction, and then you remove yourself from the process. The machine buys on the first of the month. It does not watch CNBC. It does not have cortisol. It does not have opinions about Federal Reserve policy or geopolitical risk or analyst price targets. It executes the input parameters it has been given with zero emotional overhead. Think about what this actually produces during a recession. Your automated system buys in January at $100 per share. The market drops. In February, it buys at $85 per share. In March, at $78. In April, at $81. In May, at $90. In June, recovery begins. By the time the market returns to $100 per share, your average cost basis across those 6 months is approximately $86. You have structurally benefited from the crash. The system converted market volatility into lower cost basis without requiring you to make a single decision under stress. This is not a trick, it is arithmetic, and arithmetic does not require bravery, it requires configuration. The human who panicked and went to cash in February missed the discounted purchases in March. They watched the recovery happen from the outside. They re-entered in June or July when things felt safer at a price point above where the automated system had been deploying capital for months. They paid a premium to rejoin a system they never should have left. The automation protocol did not outperform them because it was smarter. It outperformed them because it had no access to the emotional state that caused the underperformance. Remove the failure mode from the architecture. Automate the deployment. The system will do the rest.
Every recession in the documented history of American financial markets has functioned as a transfer mechanism. Wealth moves. Not out of the system. The total capital in the system is conserved, but between participants. It flows with mechanical consistency from the emotional to the methodical. The investor who sold in March 2020 when the S&P 500 dropped 34% in 33 days, the fastest decline in market history, transferred their future returns to the investor who held. Or better, to the investor who deployed additional capital. The S&P 500 recovered its entire loss within 5 months and closed 2020 up 16% from where it started. The panic seller did not participate in that recovery. They had already converted their temporary paper loss into a permanent realized one and were sitting in cash waiting for a safe re-entry signal that their own fear would never allow them to identify. This is not a moral judgment. I am not telling you that you are a bad person for experiencing fear. Fear is a correct biological output in environments it was designed for. I am telling you that you have built an investment system inside your brokerage account and simultaneously refused to protect it from its primary failure mode, which is you. The market does not process your emotions. It is not aware of your anxiety. It does not factor your cortisol levels into its clearing mechanism. It accepts inputs and produces outputs. You are either positioned to receive those outputs or you are not. That is the entire system. So here is your protocol. Turn off the financial entertainment networks. CNBC is not a financial tool. It is a drama delivery mechanism engineered to keep your attention through manufactured urgency. And every minute you spend watching red banners is a minute your neurology is being primed for the exact panic response that will cost you the most money. turn it off. Log in to your brokerage. Set your automated recurring investment. Define the amount. Define the date. Authorize it. Close the application. Do not check your balance weekly. Do not check it monthly if you can manage it. You have configured the system. Let the system run. A recession is not a test of your courage. It is a test of your architecture. The investors who come out ahead are not the ones who felt the least fear. They are the ones who built systems that made their fear operationally irrelevant. I'm Dollar Dave. Automate your deployments. Let the machine work.